Hello and welcome to NDTV Profit. You're watching the earnings review for Tuesday. Now we have IDFC First Bank, which reported its numbers on Saturday. Profit growth of about 18%, NII up about 30% year on year. I have with me the MD and CEO of the bank, Mr. V Vaidyanathan. Mr. Vaidyanathan, welcome to the conversation. First question: would this gap between NII and net profit growth, if you can explain to us what happened here?
Our OPEX was a little higher than what it should have been, about 70 odd crores. So on a post-tax basis, let me call it about 40, 50 crores. And I think we probably did a little below par.
Okay. Just trying to get a sense of the elevated provisioning number as well. That's about 45%. I wanted to get a sense as to where this provisioning has gone in, because you mentioned that AIF was not a problem for IDFC First.
No, of course, we don't have any AIF exposure, but the provisions basically last quarter same time, the recoveries from COVID write-offs were coming, while now that has ebbed off. So think of this as more normalized times, and even these numbers are like 1.3% credit loss to average book. We already guide for 1.5. So it's absolutely normal. You should expect these sort of provisions every quarter now, because that's the nature of the model.
Right, sir. On the net interest margin front, you've reported a 10 basis point upward move on a sequential basis. I just wanted to get a sense, you're already on the higher end of the NIM bracket. A 10 basis point improvement would mean that basically your lending yield is significantly higher than what the rest of the industry is working with.
Yeah, it's very simple actually. Last quarter we dropped our rates on savings accounts from 4% to 3% for up to 1 lakh rupees. So that obviously helped us in improving the margins. We feel it is stable here. We don't see any concern on this front. And the good thing is that this, with these margins, we're also getting very stable asset quality. So as a combination, it should be seen. Our gross NP is only 1.45% on retail, SME and rural, and net is only 0.5. So good asset quality with good yield. It's a good combination. I think it's a unique position to have in the industry.
Okay. During the quarter, you also gave a 5-year guidance. Now, guidance 1 point was done. Now you're looking at the second 5-year period. Tell us a little bit about the numbers that you've listed out in your releases. 20% balance sheet growth. You're guiding for about 17-18% ROE, looking at about 1.5% on the gross NPA. I think 0.4%, less than 4.4% on the net NPA. How are you achieving these numbers?
We have put reasonably achievable numbers in our opinion, because what we've done is we've just assumed that the loan book will grow by 20%, which in this country growing 20 is not difficult. We're already growing at 25. In fact, we'll slow down to come to 20 if at all we come there. So, or as we go there. So that should be a loan side. Deposit was assumed only at 24.5%. So we feel it's easy to achieve because already growing at 40. So if we just meet these two numbers, the loan book at the end of 5th year, by our, let me say, informed guidance, informed guess, which is converting to guidance, is that we'll have a loan book of about 5 lakh crores. We'll have a deposit base of about 6 lakh crores, or 585. And then with that, we believe we'll still be growing at 20%. We believe a return on equity will touch 17-18%. And that's just, and we have fantastic intellectual property because it's a very unique bank and unique, very good model. So I think that sort of picture we are aiming to get, and the numbers are reasonable. We believe are achievable.
But you said that you'd have to actually slow down from the current rate to match the guidance. I'm trying to understand where this is coming from. Is it largely because you're probably going to look at reshuffling the loan book a little bit?
No reshuffling, because we like all our businesses we're building, except that, currently growing at 24.5, our main focus is asset quality, asset quality, asset quality. We take big pride in the fact that our gross NPA is 1.5, net is 0.5. That's a bit of a, that's something we like to state, and we want that badge of honor. So for us, big focus is asset quality. And then we have guided this number. If we could do a little bit, maybe a percent or two more than that, we will definitely do.
Coming to the deposit front now, this quarter, you've reported 43% year-on-year rise. I'm trying to understand, in an environment where now most private sector banks are reporting some amount of slowdown. You also have a higher credit deposit ratio than a lot of your peers. I wanted to understand from you what the outlook for that liabilities portfolio is.
See, our credit deposit ratio is high because of the reason that should be really well understood. Because when IDFC, limited, demerged and put everything into IDFC Bank, and we merged with IDFC Bank. So this carried a lot of infrastructure bonds and borrowings, which is all 5-year, 8-year kind of long tenor loans. So our bank is today funded by deposits and those bonds. In the next 2 years, we will continue to raise deposits and we'll pay off all those bonds, or majority of those bonds.
Right.
So once that is done, the credit deposit ratio will become as good as any bank. So net today we are funded by 2 components. Tomorrow we'll be funded largely by deposits. So
in your liabilities, what percentage would that be? The long-term borrowings that you've taken in the previous?
We still have close to about 30,000 crores to repay. So imagine we'll raise 30,000 crores of deposit next few years and pay that off. And then straight away credit deposit ratio will come down. The good thing is that incremental credit deposit ratio for the bank is only 79.8%. And for the last quarter, it was 65%. So incrementally, our bank is doing very well in deposits. We are lending much less than we're raising. But this is a legacy issue. It takes time to go. It'll go.
Fair enough, fair enough. Let me get to the unsecured portfolio. There you've seen some action from the Reserve Bank of India. What is the impact there on the capital side? What is the outlook on your credit card and personal loan portfolios?
On the outlook, basically, is that we should be more careful on the unsecured credit than before. We should always be, but we should, I guess, be more careful because, you are getting certain messages from the regulator which we should be heeding, and we do. That is the reason, one of the reasons we have also tightened all our credit norms to be more safe. But just to clarify and be very sure about it, our unsecured lending is not unsecured in a traditional sense of the term. It is not that we look at the bureau score and we lend. We are lending on the basis of the cash flow. We see the cash flow in the bank or through its proxies. So if money is in the bank, we lend to that money, and then we take a checkbook, whatever, debit instruction to their account. So we are cash flow backed.
But the regulator doesn't make that distinction, right? I mean, for them, it's all the same.
So we should be careful, but at least we are confident about what we're building, and we'll be watchful.
Okay. Coming to the retail portfolio now, is there now going to be likely more reliance on secured then?
Like I said, our credit performance of both are good. The unsecured is adjusted for risk also, and as of today is even performing lesser NPA than the secured, because we have tighter norms. So we will do both, and in a judicious mix to keep credit quality good.
Apologies, I didn't catch the capital hit portion. How much would that be?
About 100 basis points.
100 basis points. Okay, and would that necessitate further capital raise for you?
Not right now. We're running 16.73%. So things are good, no problem. And meanwhile, Q3, Q4 of next year, we expect the profitability also curve to open up, our ROE to go up significantly. And if you take a 5-year forward, you mentioned guidance. We believe ROE will start to go up meaningfully from here on. So things will,
even
in a way, ROE will start adding up.
Last point on the cost ratio. So you've said your cost ratio has been elevated. Part of this is because you're in an expansionary phase right now. What's the outlook there? When do you bring it down to 65% as you guided previously?
So it will come down. You see, by Q3, Q4 of next year, we believe it should come down because some businesses which are loss-making today will become profitable. We'll pay off the bonds which are maturing, etc. So by Q3, Q4, there should be a reasonable reduction. But we are, we have now taken the picture forward. While we will keep this guidance alive till the last date we have guided it for, and we track ourselves against it publicly. But we believe that if you take a 2-3 year forward view, this should meaningfully improve. The reason is very easy to see because now our loan book is, we've guided for compounding only at 20. Our deposit machine is being built to be able to fund that. So we expect the drag on liability side to reduce from now on.
Apologies. One addendum on the budget expectations. What is your expectation looking like?
I think it's more a vote on budget account. But the thing is that continuous investment in infrastructure, agriculture, and boosting the economy, and to run a tight ship on the users of money. That's what I think.
All right, Mr. Vaidyanathan, thank you so much for joining us on this conversation. It was a pleasure talking to you, sir.